So friends, now I continue TP in second part. In the previous first part, I have covered the basics for associated enterprises, international transaction, our TP method, and overall the picture of TP I discussed in the part. I would say second part is advanced stage. This part we will discuss all typical part of the transfer pricing. So let's begin with the TP part 2. So BEPS, base erosion profit shifting, it's a OECD action plan 13. They have implemented OECD introduced 3-tier approach, country by country reporting, local file, master file. So in the Finance Act 2016, the Income Tax Department has introduced two new sections, Section 92D and Section 286. For procedure part, they have implemented Rule 10DB and 10DA. They have incorporated forms AC, AD, AE and AAB, right? So if you are a fit in this case, you have to maintain master file. If you are maintain in this case also, you have to report in CBCR form. So let us discuss master file first. So CBDT, this is in outcome of BEPS action plan 13. Section 92D has also been amended, right, in respect of master file. So what the master file contain? It should provide an overview of M&E business. Multinational enterprises have to maintain their business, what is the nature of global operation, overall TP policy, what is your TP policy in India, what is your TP policy in UK, allocation income, how you allocate royalty to another country, to the country where your intangible is situated, economic activity. Master file is not intended to provide exhaustive detail. It is basically contain group structure. What is your group structure is there. Description of business, what you do here in India, it's related to procurement and sale, what in the abroad, what they are dealing, where it is your intangible, where is intercompany financial activity. So these kind of group master file is need to be maintained. So if your consolidated group revenue more than 500 crore, ji haan, we have to see your consolidated group revenue, it's more than 500 crore, and your transaction, international transaction with Indian AE to the US AE is more than 50 crore, or the intangible related transaction is more than 10 crore, suppose we are paying royalty for more than 10 crore, then you will covered to maintain master file. Every constituent entity has to file part A. Part B कब भरना है? जब आपका this threshold is applicable. So typically you have to maintain master file part B also. The due date is before furnishing ROI. So your ROI due date is 30th November. Out of all constituent Indian entity, group shall designated one Indian entity. Suppose in India there are Sony India 1, Sony India 2, Sony India 3. So Sony World will decide which one entity is your designated entity. So designated entity intimation need to be given in form 3C AB, right? This intimation is need to be given for the purpose of filing 3CEA form. So this is related to Section 92D. Rule 10DA is prescribed. This is the threshold. It is applicable in case where the consolidated group revenue is more than 500 and transaction is either 50 crore and 10 crore in respect of intangible. So you have to maintain master file. What else? If you don't maintain master file, what the penalty is there? Penalty is 2% of international transaction. If section 271 AB is provide, section 271 BA is provide 2% of international transaction value, the penalty can be levied. So now I come discuss with the CBCR, Indian CP, country by country reporting. So rule 10B prescribe your total consolidated group revenue of international group is 6,400 crore. It is an Indian currency. You have to, if your group consolidated group is more than 6,400 crore, typically it's around 714 million euro. If you cross this threshold, then CBCR reporting is applicable to your company, right? So parent entity is a resident in India. Your parent entity resident in India or alternate resident is resident in India, then you have to file 3CE AD. AD is a country by country reporting. CBCR you have to file by the 30th November. It's a due date for ITR, right? To whom you have to file? It's a joint director or director general of income tax, right? Who has to file, what form has to file, when it is filed, to whom it is filed. So it is filed by your parent entity having a Indian residency in form number 3CEAD by 30th November to joint director or director general of income tax, right? I take another example. Constituent entity resident in India which is part of international group. आपकी पेरेंट एंटिटी इंडिया में रजिस्टर्ड नहीं है, इंडिया में रेजिडेंट नहीं है, पेरेंट एंटिटी सिचुएटेड इन यूएस बट कॉन्स्टिट्यूएंट इंडिया, सब्सिडी इन इंडिया इज रेजिडेंट इन इंडिया. You have to file 3CAC, also you have to file 3CAD, right? AC you need to file at least 2 months before the due date, that is 30th November, 30th September you have to file 2 months before the due date, and your CBCR will file by the 31st March. So in case of constituent entity resident in India, you have a relaxation till the end of the financial year, 12 months from the end of the reporting period, that is up to 31st March you can file, but intimation should be 2 months before due date. So it is now concluded in this manner. If your parent entity resident in India, your due date is 30th November. If you are a constituent entity but your parent entity is non-resident, then 2 months prior to ITR due date, you have to make an intimation to the joint director of income tax. I am not my parent is not a resident in India. So in that scenario, your CBCR due date is 31st March. Now I discuss what happen if you are more than one constituent entity in India. Then you have to choose which one as a designated entity. The intimation should be filed with also in form 3CAE. The designated entity where there are multiple constituent entity registered in India, resident in India, that are part of same international group, the consolidated group revenue of which is exceed the prescribed limit. So limit is 6,400 crore. So 6,400 crore, but your consolidated group revenue in their local currency, Euro, USD, then we have to check what is the TT buying rate as on the 31st March. So I have took TT buying rate for 31st March, end of the financial year. Maybe it's end of the accounting year. In your case, the 31st December, then TT buying rate from the RBI side, I have taken on 31st March 89. So IG group revenue in Euro amount in million is 714. So this is just little bit lower. As you see in global rule, there is a 750 million euro in respect of global rule applicability, that is in place, it applicable soon. So in this scenario, even though your revenue is less than 750 million euro, it's just 714 million euro, you are covered CBCR reporting. So typically primary adjustment is done. If there is a TP adjustment, your case is referred to the TPO, AO make a addition, it is decided it's a primary adjustment, you have undervalued your transaction, there should be a ILP addition, so they have make a primary adjustment, but the primary adjustment is more than 1 crore. It is required to repatriate fund from abroad. If you don't do, then we will charge interest. There is a primary adjustment. It is a difference between the transfer pricing determined based on the arm length principle and transfer pricing at which the transaction took place. That difference also represents excess money with the AE that is required to be repatriated in India. So interest need to be calculated. So what you do, you have to repatriate that fund into India. If you don't do, for delay period, you have to charge interest. So there is another option with you, secondary adjustment. Section 92C 10 CB says, if there is a sale transaction with the foreign AE, you took sale at 100, but ALP decided is 170. So excess money lying with this foreign company is 30. So this 30 should be repatriated back to India. There is a purchase transaction, excess lying with the foreign company, 20 should be repatriated back to India, right? So what happen if you don't charge interest in respect of primary adjustment? What other option is there? The other option is secondary adjustment. You can pay one time 18% tax on this excess money lying with the foreign company. You don't require to charge interest. You came out from the provision of primary adjustment. This is the provision in respect of secondary adjustment. Here I will also discuss what is the corresponding adjustment. Corresponding adjustment is still not in the Indian TP regulation. It is as per the treaty. Suppose you have you are going through MAP, mutual agreed procedure. The competent authorities allow you. Suppose they make TP adjustment in respect of A associated enterprises, the counterpart corresponding adjustment will reduce from the income from B associated enterprises. That is a corresponding adjustment not covered in the Indian TP, but it is allowed as per the treaty. As per the double taxation avoidance agreement with the country, the MAP competent allow you corresponding adjustment also. So I discussed primary adjustment, secondary adjustment, corresponding adjustment. So what is the advanced pricing agreement? So APA, in order to avoid too much litigation, you can in advance make an agreement with the income tax department for forward 5 years. What the transaction should be done, at what price, what you apply, which method you apply, and how this transaction took place. You can go back for 4 rollback period, so total 9 years is covered. This APA agreement can be unilateral or bilateral. Unilateral in case you are dealing only with associated enterprises and not making counterpart application with in another country associated competent authority, that is unilateral. If you in India make an application with the competent authority, simultaneously you make another application in corresponding country where the AE is situated, make corresponding application to the competent authority, that is a bilateral APA. So there is a process of APA department for pre-filing. There is a huge fees is charged in respect of APA, 10 lakh approx, right? In case of rollback, 5 lakh also is charged. APA evolution is there, main filing is there, negotiation, you have to do negotiation with the department. This method should be taken for the purpose of ALP. And after that, once the APA is signed, you have to do annual compliance audit with the APA. So what is the pros and cons? So there is a certainty for 9 years to simpler compliance after the APA has been entered. Reduced documentation burden, right? Time and cost saving, preferred by the tax authority. Mandatory pre-filing consultation help in taking decision making. So in a very initial stage, you can pre-filing consultation with the department. Possible persuasive value in litigation. In litigation, there is a litigation. After that, so many litigation can be arise. But if you go for APA, there is a less number of amount of litigation. High upfront cost. जी हाँ, there is a huge upfront cost they charge. No time limit for finalization. 2023 is a great year. The department has filed number of APA. So now APA's craze is increasing day by day. So what is a safe harbor rule? Safe harbor rule, same way, presumptive taxation department has given a prescribed rate in respect of this industry. Suppose you fall in this KPO, ITES service, you prescribe this rate, then we will not touch upon anything. But before you chosen for safe harbor rule, you have to file an application that AO will approve that application. So in short, I will discuss for software ITES service there is a 17%, 18%, KPO is 18%, 21%, 24%. In KPO they have taken a base for employee cost to total cost, then your OP margin should be in this bracket, more than this bracket. This is the basic rate, right? In R&D case 24%, R&D case up to 200 crore, generic pharma case 24%, intra-group loan services there is a rate based on the your CIBIL rating. Corporate guarantee case 1%, exact 1% of guarantee amount. This is your threshold limit for safe harbor rule. In auto company case 12%, non-auto component case 8.5%. So intra-group services 5% markup is there. So this is the safe harbor. Without going any further litigation, you can choose in advance. I am going to apply safe harbor. The due date is same, your ITR due date, and if you can choose for 5 years, there is a prescribed form you have to file online with the assessing officer. So thank you guys. Hope so. I have covered everything in respect of transfer pricing in easy manner, so you can understand the complex subject in easy way. Thank you.